As you look at the selling that we're seeing right now, Julie had mentioned we're in a pretty tight trading range up until this point, and then we kind of saw the bottom fall out a little bit here. Are you worried when you hear news like Deutsche Bank clients, some Deutsche Bank clients pulling their funds?
Well, it's not good news when you're a bank. Everything's relying on trust, but also they haven't hit the tipping point. The tipping point is when it's spiraling and everybody's moving out. This is a few clients. They've adjusted collateral. I'm focused on U.S. stocks, so I can't give you the real insight into Deutsche Bank specifically.
But we see U.S. financials getting hit in the process.
Yeah, and it makes sense because that's where, if to the extent one bank has troubles, then it is, well, how does this impact the other banks? And I do think you will have a stopgap in the mechanism. I think the central banks globally have been pretty clear in their support of the financial system, and this would be one that actually does impact the financial system.
So, I mean, Scarlett gave sort of a litany of all the things we have to weigh, not just today, but more broadly. Economic data today in the form of GDP, pending home sales, et cetera. You have what's going on with the global banking system. You have OPEC in the mix as well. That's not even mentioning the Federal Reserve, right?
Oh, yeah, that.
So, I mean, you've got a challenge right now, obviously, weighing all of these things. Is there any one of those that is more important than the others, or are you weighing it all, and what's your conclusion then in terms of whether to be more bullish or bearish bias?
Well, I'll tell you, it's where there's a challenge, there's an opportunity. And I think the opportunity is that those big macro things that do matter are the focus right now of the market. So you go through periods where correlations go up and stocks move in sync. And to the extent the fundamentals are not as highly correlated, at the company level as they are at the market level, that's where opportunity comes. So you do have right now, I would say, a risk-off feel to the market. And a min-vol strategy, which historically makes sense from a risk-adjusted return, might be, a crowded trade. So you see the chase for yield, the view that low vol equals safety or low risk, and it's all dependent on what price you're willing to pay. And right now, I think the other side of that trade is, I'd say now's the time to be aggressive.
Is volatility cheap enough to get aggressive?
Yeah, and it's not as cheap as it was just 3 or 4 months ago, but it's still pretty attractive. So even if you look at within the sectors, if I'm looking within healthcare, the more volatile names, the ones more subject to concerns over pricing mechanisms put in place by the government are probably attractive. And then if I'm looking at it, let's say within energy, if the underpriced stocks are the mid-cap B&Ps, not the big integrated oil companies.
And I want to just bring up some of the sectors here since you mentioned them. This is the RRG function on the Bloomberg, and you can see which sectors are leading or lagging. The leading sector here is technology. That's on its own, and financials are improving, but everyone else, Julie, seems to be in the weakening or lagging phase.
Well, and I wanted to ask you about tech specifically, actually, since it has been in that leadership.
Yeah.
Is it too much in leadership? Is it getting expensive?
Well, no, there's a reason tech's been in leadership. People are starved for growth, and that's where there is some growth. And actually, there's positive developments. If you look especially in the tech hardware side, you've had, like in DRAM, you've had an industry that went from 16 competitors to 3. And that's when you get margins, and so you've got tremendous opportunities for the companies. And you see the NXP deal today.
Yes, you do.
Yeah.
Potentially.